All right, welcome back. Stocks, well, taking a little bit of a breather, but it's been a big year, especially in tech. So what's in store for the new year? Let's bring in Ann Sonders now, Schwab's Chief Investment Strategist. Good to see you. Welcome back.
Thanks, Scott. Happy Thanksgiving.
Yes, and the same to you. I'm sorry that I missed you as well at Impact, but...
Yeah, ditto.
Do it next year.
That nasty COVID thing.
Yeah, well, it's good to have you back. So
thank you.
Let me ask you this. I'm looking at the notes, and you say that it doesn't yet look like a durable new bull market. That says to me you're not a believer in what's happening in the market right now in terms of this rally, and why not?
Well, first of all, as we know, this year has been dominated by the Magnificent Seven. So if you look under the surface, you look at equal weight, you look at the S&P 493, you look at small caps. I actually think the leadership there or lack thereof is reflective of all the uncertainties we talk about with regard to Fed policy and where the economy is. It's just in cap-weighted indexes, they're biased on the upside. But there was lots of analysis done by us and everybody else at the point where we hit the one-year mark in the move from the S&P low now 14 months ago or 13 months ago, and the absence of participation by small caps, by banks, and weak breadth statistics just said that there was still something lacking. That doesn't mean that the indexes have to retest prior lows. I think we can kind of muddle through, but I think for a sustainable move, I think you need to see a broadening out. And I do think there is a lot of money itching to move into areas other than those mega cap names, and that may be where the opportunity sits next year. So
the bottom line is that until you get those other stocks to do anything in a meaningful and sustainable, probably the best way of saying it, a sustainable way, it's just not, you can't say we're good. You just can't yet say we're good.
You could just say that the market is incredibly concentrated and performance is driven by a very small handful of names. That's not in and of itself an imminent risk for the market. That often happens with cap-weighted indexes where you get performance bias up the cap spectrum. It's when you've got dramatic underperformance by the remainder of stocks. Now, it's not as bad as it was at the beginning of June when you had a record low percentage of the S&P at that time outperforming the index itself over the prior 3 months, over the prior 6 months. That's improved a little bit, but I think broader participation, more soldiers on the front line, so to speak, as unpopular maybe as battlefront analogies are, I think would be a sign of a more sustainable rally, especially if financials and banks in particular can start to play some catch up.
What's the likelihood that we get that?
We probably have to get past some of the near-term concerns with regard to some of the debt coming due as we roll into 2024, the constraints from a credit environment. I don't think we have anything resembling a 2008 scenario, but I think that's clearly one of the things holding banks back is even though we're not suffering from contagion associated with what happened back in March, though that was more idiosyncratic, but we still have in front of us the concerns within those same smaller and regional banks of deposit flight and exposure to kind of the weak links within commercial real estate. So we may need to have a little less opacity there to get a sense of whether what looks to be a pretty decent earnings trajectory for those stocks actually provides enough comfort to get more sustainable buying interest.
You know, it's interesting, the Fed minutes today, there were no surprises. A lot of the similar language that we've been consistently hearing. They did say, though, to your point, that financial conditions have tightened significantly. Not that that's new, but that it's on their radar. Now, they obviously feel, I would assume, and we think, that they can control the fallout, so to speak, from the fact that those conditions have tightened significantly, in their words. You're just not wholly convinced that there's still to be some level of fallout that's going to weigh on the market at some point.
I think it's more, in terms of the commercial real estate exposure, I think it's more of a simmering problem over time as opposed to, a Lehman-esque moment in time. If you just look at how widely spread it is, the fact that the exposure is in the traditional banking system, but also the shadow banking system, and a graduation in terms of when the debt comes due. So I don't think it is a moment in time. But specific to the Fed, one thing we have to remember when looking at these particular Fed minutes is that was a discussion that happened before the fairly benign inflation report. I think since then, it very much cements the idea that the Fed has done in this cycle. I think what is still yet to be decided is whether the market's expectation of cuts starting as soon as May has validity. And if you extrapolate the current combination of circumstances, I'm not suggesting that's what's going to happen, but if you do, inflation not yet at the Fed's target, employment having had some cracks but still hanging in there, the economy doing okay. To me, that doesn't justify rate cuts, even though if inflation continues to come down, it means real rates go up, even without the Fed doing anything. I think that they at least subtly pushed back against that if you read into maybe the backstory of the minutes.
So if you believe that the Fed is going to cut, let's just for argument's sake say May, right? The market's placing a bet that it's going to be around that period of time. Would you feel comfortable then buying small cap stocks here? I mean, last week, obviously, the Russell was up 5%. In the last month, now much of it done last week, we're up about 7%. What's the moment that you would say, you know what? Okay, they're going to cut, and that is an area that I need to be in now.
All right. Well, if they cut, it's probably because you've had more deterioration in the economy broadly and the labor market more specifically, which could be the trigger. And by the way, I think if and when that happens, whether or not it's ultimately declared a recession, I'm not sure that matters as much. But near-term weakness in the economy, I think, is the better scenario from the perspective of the Fed for the equity market. It probably means a further re-rating down in forward estimates. But I think what the kind of trigger is to your question is a sense that the forward estimates, the trajectory turning back higher, are valid because the swing factor in small caps is much larger than the swing factor in large caps. The rub is whether we can rely on those 2024, 2025 estimates. I'm not sure that they really reflect reality at this point. That said, small caps, you can't look at monolithically. Russell 2000 has, about 1,850 stocks in it. 30% of that index is zombie companies. I think about 40% are not profitable. So if you want to use an index to start as a base to look for opportunities down the cap spectrum, start with the S&P 600 because it's got a profitability filter. So I think you still want to stay up in quality, even if you're going down in cap.
But what's also inherent in the point that you're making is that you don't subscribe to the belief that the Fed will cut because it can, not because it has to. They can cut because inflation just has trended to the point where they feel comfortable doing that, cutting rates.
But if you have inflation still above their target, the labor market not deteriorating, and the economy still hanging in there, I think they would view that as too much of a risk to start cutting, not to mention potential credibility issues. So I actually think the point at which the Fed starts to telegraph or actually initiates rate cutting, I think where they're going to get that message from is probably the other mandate aside from inflation, meaning the labor market. Clearly in the hiking cycle, they were focused on and driven by the half of their mandate that is the inflation. I think what they'll key off of more in terms of when to cut is probably going to be the labor market coming into clearer focus where they have an eye on both of the mandates as opposed to just inflation.
I gotcha. Great having you, as always, and happy Thanksgiving to you and your family.
You too. Thank you.
All right, that's Ann Sonders joining us here.